The income tax trap. Most people pay taxes on their wages. This is called income tax. It's taxed at the highest rates, up to 37% in the US. The rich rarely rely on wages. Instead, they rely on capital. What is capital? Capital is money that makes more money. It's assets like stocks, real estate, or businesses. When you sell an asset for a profit, that's a capital gain. And here's the secret. Capital gains are taxed at a much lower rate than wages, often just 15% or 20%. The first rule of wealth: stop trading time for money. Start trading assets for growth. Wages are taxed heavily. Capital is taxed lightly. Depreciation. This is the biggest loophole for real estate investors. Let's say you buy a rental apartment for $1 million. The government assumes buildings wear out over time. So, they let you deduct a portion of the building's cost every year as an expense, even if the building actually goes up in value. This deduction is called depreciation. Here's how it works. You collect $50,000 in rent. That's income. But you claim $40,000 in depreciation expenses. On paper, you only made $10,000. You pay tax on $10,000, but you keep the full $50,000 in cash. You're making money, but telling the IRS you're barely breaking even. It's legal, it's standard, and it's how landlords pay little to no tax for years. Borrow, don't sell. Why do billionaires never sell their stock? Because selling triggers capital gains tax. If Elon Musk sold $1 billion in Tesla stock, he'd owe $200 million in taxes. So he doesn't sell. He borrows. He goes to a bank and says, I have $1 billion in stock. Lend me $50 million against it. The bank agrees because the stock is collateral. Loans are not income. So, Elon gets $50 million in cash to buy islands and rockets, and pays zero tax on it. He only pays interest, which is tiny compared to the tax he saved. When he dies, his heirs inherit the stock. Thanks to a rule called the step-up in basis, they can sell it immediately without paying any capital gains tax. The tax liability disappears. Don't sell. Borrow. Tax deferral. The government wants you to save for retirement, so they offer tax breaks. The most common is the 401k. You put pre-tax money in. If you earn $100,000 and put $20,000 in your 401k, the IRS only taxes you on $80,000. You lower your taxable income immediately. The money grows tax-free until you withdraw it at age 59 and a half. Then there's the Roth IRA. You pay taxes on the money now, but it grows tax-free forever. When you retire, you pull out millions, and the IRS gets zero. The rich max these out first. It's the easiest, safest way to legally avoid taxes. If you're not using these accounts, you're voluntarily overpaying. Charity hack. If you give cash to charity, you get a tax deduction. But the rich do something smarter. They donate appreciated stock. Imagine you bought Amazon stock for $1,000. It's now worth $10,000. If you sell it, you pay capital gains tax on the $9,000 profit. But if you donate the stock directly to charity, you don't pay the capital gains tax. Plus, you still get a tax deduction for the full $10,000 value. You support a cause, wipe out your tax bill, and avoid the capital gains hit. It's a triple win. Never sell appreciated assets if you can donate them instead. Capital gains. Not all profits are taxed the same. If you buy a stock and sell it within a year, it's a short-term capital gain. It's taxed like regular income, high rate. If you hold it for more than a year, it's a long-term capital gain. It's taxed at 0%, 15%, or 20%, low rate. The rich plan their sales. They wait until they've held an asset for 366 days. They also time their sales for years when their income is lower, to stay in the 0% or 15% bracket. They don't just sell whenever. They sell strategically. Patience literally saves you thousands in taxes. Loss harvesting. Markets go down. The rich use losses to their advantage. This is called tax loss harvesting. If you have a stock that lost value, you sell it. You realize the loss. You can use that loss to offset gains elsewhere. For example, if you made $10,000 profit on stock A, but lost $10,000 on stock B, you owe zero tax on the profit. The losses cancel out the gains. If you have more losses than gains, you can even deduct up to $3,000 from your regular income. Don't just hold losing stocks hoping they come back. Sell them. Use the loss to reduce your tax bill. Then, buy a similar, but not identical, investment to stay in the market. The code, reality check. These aren't illegal secrets. They're in the tax code, but they require knowledge. The average person relies on payroll withholding. They never see the money, so they never question it. The rich structure their lives around these rules. They hold assets long-term. They borrow against wealth. They depreciate real estate. They harvest losses. You don't need to be a billionaire to start. Open a Roth IRA. Hold your investments for a year. Look into real estate. Stop volunteering for higher taxes. Read the rules. Play the game. Keep what you earn. Taxes are inevitable, but how much you pay is a choice. Educate yourself. Consult a CPA. And remember, the government can't tax what you don't realize. Structure wisely. Stay legal. Stay wealthy. Thanks for watching. Subscribe for more financial truths. See you in the next one.